Hey folks, glad you could join us on yet another conversation on Business Redefined. As always, this is your weekly, most comprehensive look at the world of business, finance, and economics. And our pet subject on this show is either public finance or the banking sector. Now, today we want to focus on the latter. And as always, a privilege to have Mr. Abraham Ongenge, the guy leading up the retail business at Stanbic Bank. Abraham, karibu sana.
Thank you very much. How are you?
Fantastic. How's it been since our last conversation?
Good. I'm glad to be back.
All right.
Things looking better than they were the last time, and looking forward.
Abraham, we are all on the build-up to midnight, November 30th, transitioning into Deck First. Why? Because of the overhaul of the credit risk-based pricing regime, especially for new loans. Because for existing is February next year.
February next year, 28th February.
How are you preparing yourselves, especially because in the retail franchise, I'd imagine pricing of credit is a pretty sensitive topic?
Yeah, and I do think the new risk-based pricing thinking is quite aligned to the banking sector charter around how we think about transparency in our pricing. And one of the key challenges that came out when we were transitioning from the old is the issue around market observable rates. Yeah. And the launch of Kesonia and CBR as an alternative are key indicators to kind of create transparency around how market observes interest rates movements with the movement in pricing for their own lending portfolios. Now, as a bank, we've kind of put in some thought around how we create that same transparency, but also allocate individualized credit for our customers. And there will be key changes that you would observe in this process. One is that Kesonia and CBR are actually externally disclosed. So the Kesonia will be run daily by the Central Bank of Kenya. CBR will be a conversation that will be happening every single time we have the Monetary Policy Committee. So that creates a little bit of transparency around the base. I think one of the other changes is the role of the Central Bank of Kenya and the role of banks in pricing, where Central Bank of Kenya continues to provide the oversight role, but banks now own the governance and the approval of the pricing methodology. This was something that was quite gray in the previous regime, where we did have delays in banks implementing new risk-based pricing. So our ability to then implement becomes much clearer. Then lastly, one of the things that you'd see that's quite a big shift is the appreciation of market dynamics and competition, where banks now would be able to offer the same kind of base and then a build-up of what you would call a K, which would be then the key differentiation. So for the customer who you want to shop around, the base is the same. You then now go and say, what's the K in this bank? What's the K in the other bank? Therefore, you have better choice as to who prices you better, and you can shop for better opportunities for credit.
The question that emerges, Abraham, given what you've said, is we are transitioning to a regime where the key factor here in the baseline is what you call the compounding in arrears. And many Kenyans are asking, in a very simple way, what exactly does that mean when it comes to the factoring in of the interbank rate and how it changes on a day-to-day basis?
Yeah, so one of the things customers asked when looking at base rate is to say, how dynamic is the bank's base rate to market movements? Now, Kesonia, which is the average of the overnight interbank rate, then provides daily adjustments to that. Now, for a retail customer, that can be a bit of a tough one to kind of comprehend. But the way the advice has come and the methodology is to say customers will be able to get what that average rate is 5 days into the end of the month, creating a little bit of certainty. The regulations have also appreciated that some of this by choice may be complex. Complex either to implement in various banking systems or complex for the customers to understand. And therefore included in contracts would be the choice of using the central bank rate, which will be much more certain, but then it would have a lag, almost a month lag. So on customers who are more informed, your corporate customers as an example, Kesonia probably becomes a much more dynamic rate that is well understood that they can also model. For some customers, especially on the retail and the medium-sized enterprises, they would have a choice of saying, can we take products that are central bank rate based?
But do you expect that that transition then will usher us into turning a corner from a credit growth in the private sector perspective? Granted, we are seeing improvement, but we are still in the low single digits, which is a terrain we shouldn't be playing at, given how our economy grows on average. I think from what we saw historically, we should be somewhere in the mid-teens thereabout. Do you think that will take us into turning a corner?
Yes, and I do think the policy actions right through the year have in a way supported to kind of set the pace around us turning the corner. If you think about late 2024, we had average interest rates in banks of about 17%. Yeah. We are now sitting just slightly above 15, about 15.1% as at September. We've seen the response. Private sector credit growth grew by about 5% by September, and mostly supported by building and construction, manufacturing, and consumer durables. We still see some lag in the personal household space, but the transparency we see and the new changes where customers are now being priced much, much better and are able to actually shop around, then would create a little bit more trust in balancing of growth going forward. So I'm quite confident that the private sector credit growth will recover.
And from a credit risk perspective, the latest update we got from the Central Bank of Kenya indicated there was a bit of improvement from an NPL ratio perspective. I am not sure whether it is predominantly a function of the denominator remaining stagnant, or it is a case of we are actually seeing a quantum improvement in the numerator.
Mm-hmm. Mm-hmm. So I do think there's some shoots of progress. When I said building and construction improved, there is an element of the deliberate action of the government to start settling some of the pending bills. That introduces liquidity in the economy. We did have some little bit of volatility and uncertainty when we were going through new taxes in the year 2024. I think we are seeing customers now settling down to the new normal and are now able to plan much better. That then starts to improve with some level of certainty around growth on the personal side. Agriculture continues to show a little bit of good progress, albeit a bit cautious, especially for commodity prices. But we do think it will sustain. I don't think we are out of the woods from an NPL ratio. There are still some what you would say sticky names that would require a much lengthier resolution time across the industry, but when the denominator grows and it remains sticky, then you'll start seeing the NPL ratio coming down.
Okay. And from a conversation we were having a little earlier is on the household dynamic of credit growth. What are you seeing there as you look at the retail book? Are households gobbling up a little more right now, or are they still abundantly cautious? How is it playing out?
Abundantly cautious. Abundantly cautious. I think the taxes and the reduction in disposable income did provide some shock in various households. I think they are now normalizing and getting into the new normal. So we are seeing some shoots coming. There is a lot of work that has been done by banks. One key example is a structure around affordable housing that has allowed some level of certainty on interest rates. And we do play a big role there as Stanbic Bank. That has created confidence because it creates certainty in price. We've seen a lot of employers coming in to support their employees through various specific employee value banking schemes, where they do take some level of risk sharing to help their customers and their staff grow from a lending perspective. So some of these innovations have started to bring back appetite for credit in the industry.
And for us who have predominantly been watching Stanbic as a corporate focus, corporate investment banking focused, and the perception, and maybe it's a fact, that you are actually overweight on that side, given the sort of arm that you're now leading, do you feel that you are rebalancing the portfolio, if I could put it that way, to be retail and corporate?
Yeah, most certainly. And we've taken the view that our strength in corporate and investment banking allows us to be much more relevant to the sectors where we operate within the corporate, even at a personal side. So we partner a lot with our corporates by offering very, very good schemes for their employees. And in fact, because we understand the employer, we can be much, much finer in how we think about their banking journeys for their employees. We also do think that we can play a very big role in supporting our public sector. We have one of the most competitive sector offering from a lending perspective for government. And we understand that some of the things that prevent people from accessing credit is ability to provide collateral.
Yeah.
So we've increased tenors, some tenors up to 144 months. This is 12 years, but we are asking our customers, we don't need security for that, especially within the public sector, because we do want to support the public sector as well to meet their organizational dreams. I do think we can do much, much more, especially on the lower segment. And we are looking at various areas where we can support the lower segments by offering short-term lending facilities for the lower segment.
Is your appetite for public sector anchored on some risk-sharing guarantee kind of structure? Because the risks of public sector are well known to us. The reason why we recurrently talk about pending bills is because of public sector exposure in businesses. How do you design yours to ensure then that even as you whet your appetite on that side, you are adequately safeguarded?
Yeah, I'm actually a beneficiary of a parent who worked in the public sector, and I'm proud to say that the public sector supported my own education. One of the things that we have learned is that deep sector expertise and supporting the public sector, both from a corporate side, helps us understand the risks better. So where we have chosen to get into the public sector, even on the personal banking side, we have deep understanding of both the risks and returns. A clear example is our teachers, who do quite some great work in supporting to build the educational capacity of our society. What you would notice is that you would remember your teacher even in your senior years, because they have stayed the long haul as employees. But then you do need to then give them the benefit of the fact that they are here for the long haul and provide them appropriate credit that has much better payment structures, because you know a teacher would always be a teacher. Same thing when you think about building and constructions, and you're saying, how do you understand the connection between public-private partnership and government, mitigate the risk, and then support that? And that would go even to the people who then do the work on the ground. So whether it's masonry, whether it's deliveries, whether it's truck transportations, then you support them because you understand the bigger picture of what we're trying to do as a country.
I'm just curious, based on what you've said, Abraham, how large is your education-focused book? How do you intend to scale it?
So our education focus book is an area of entry. And when we started our solution, we virtually had nothing in terms of lending to teachers. We've seen that grow by about 40% this year. We are now hovering about 2 billion of lending to teachers. And we want to see that growing into the tens very shortly.
Okay. And as you still drill down into the retail lending, what are some of the wealth management solutions then that you couple with the lending solutions that you're giving? Because of course, as we speak, every other Kenyan is asking you about MMFs and many other asset classes out there. How does Stanbic then position itself for this?
Yeah, and we've actually understood the dynamics on wealth in various perspectives around, first of all, understanding the journey of your customer, and different customers in their different journeys have different wealth needs. We have seen transition of banking into various aspects. We've seen more customers now wanting more than transactions. To actual relationships, and we build then those relationships for the long term. We have seen a lot of customers looking for alternatives, especially from a currency perspective, and we are able to provide solutions both onshore and offshore to manage liquidity and investment needs for our customers. For your Gen Z type customers, new asset classes are starting to encourage them. So they are looking more for democratized type of investments. So can I save little but enhance my yield? So your MMF with better yields will become quite attractive for them. We are seeing a lot of the wealthier customers wanting to manage this cycle of lower interest rates by creating some level of liquidity buffers so that they can be able to tap into opportunities whenever those opportunities arise. So a balance of liquidity management becomes key. So they wouldn't want to invest in something that will tie them up because they also want an alternative should they need to do so. There is a balance for real estate, and our partnership with various experts within real estate has allowed us for the wealthier customers to offer those solutions, both from a financing perspective, where you have hard liquidity that you want to retain, but you want to leverage it. We can actually provide leveraging solutions so that to allow our customers to continue to grow their wealth, even when they have parked some of their money in long-term assets.
But Abraham, I'm wondering, for your large ticket clients who you're saying want to ride out this wave of depressed yields, if I could call it, or softening yields for that matter, with pretty much a liquidity play, how more liquid can it get beyond the MMF? Because remember, it is meant to be the next closest thing to your bank account.
Yeah. There are different balances for risk and return. Your money market funds are quite liquid, but they're not capital protected.
That's true.
For some of these customers, capital protection becomes quite key. Now, while you can do simple government bonds and you lend to government, you have some level of protection there. Sometimes you need to diversify your concentration across geographies is important. What we offer such customers is to say, can I offer you diversification across geographies? So can I get you a Eurobond as an example? Can I get you exposure in Uganda as an example? So that your sovereign risk is also balanced. Sometimes they may not have access to key corporates who are looking for liquidity. We did see one corporate come out to the market to issue a bond, and some of our customers would like exposure to private companies without necessarily having shareholding.
Yes.
We will facilitate that.
As long as they're investment grade.
As long as they're investment grade. So we do the financial advisory, but we also provide that opportunity.
And this is fundamentally through SBG, I presume?
Through SBG, yeah.
I see. Yeah. Wonderful. Digitization and the impact it has on, one, your distribution of products, and two, how you are reaching out to the new demographic of bankers as well as investors.
Yeah, and one of the things that we've found quite key is that if your products are not in a digital platform, you're probably not scaling enough. And we've adopted a digital first type of approach, where when we think about a solution, the next thing we think about is how do we provide that solution digitally. We have seen that varies from product to product. As an example, in our surveys with our customers, we've seen that money market funds, investment products sell quite well digitally.
Yeah.
People understand them, they are able to take them digitally. When you look at planning products, such as insurance products, a customer would want a digital journey, but a little bit of assistance to understand when this happens, how will I be protected? How will this go? So it kind of comes on semi-digital. Your other bank easily type products are fully digital. We run about over 91% of our transactions completely digital within the retail segment. A lot of the others would understand some complex lending, which would require a little bit of person-to-person engagement. But many simple retail business, we are kind of running it digital. There is also the dark side of it, and the dark side of it being the emergence of cyber risks and the emergence of fraud. One big area of concern for us is social engineering, where a lot of our customers in the journey to learn the use of digital products are falling victims to social engineering scams. We do need to do a lot of education on an ongoing basis. And I think it's important as we move into this season of Christmas and the holiday season.
Yeah.
It is Black November. So there's a lot of transacting activity for our customers, that we stay alive to some of these social engineering scams.
There are a number of banks which tell me that just the way you're seeing a lot of elevated risk from the cyber security standpoint, AI has provided unprecedented capabilities in terms of weeding out this fraud. Are you doing anything on that front?
Yeah. We have implemented various use cases to try and protect our customers against some of these. One of the things we did implement this year is that we enhanced our fraud monitoring tool, which then learns the behavior of our customers and is able to pick out behavior that's uncommon. As an example, if we find you transacting in the Bahamas and we've not seen history of you ever being in the Bahamas, you'll receive a call from us and say, we are happy that you're in the Bahamas, but are you sure that's you? We've also implemented customer onboarding checks, where we do a little bit of due diligence whenever we are picking new customers, because this is one of the other challenges we have around scammers onboarding into our platform. So we check various other informations to just make sure that we are onboarding the right customers.
You know, I would have continued with that conversation with Abraham Ongenge on trends in the banking sector, but because my boss, Agatha Lenjo, is on my case here telling me that it's out of time and we need to wrap up this discussion, thank you so much for creating time for this conversation, Abraham.
Thank you for your time as well, Julian.
The man in charge of retail banking here at Stanbic, we have been covering a raft of issues, most notably the transition we are all anticipating effective December 1st, that is the transition on the risk-based credit pricing. We shall continue to break it down as and when it happens, so keep it business redefined.